There's no doubt the most passive form of income is dividend investing. You can make a one-time investment and get paid for the rest of your life. Dividend investing has a massive snowball effect over time, causing not only your portfolio to grow, but your dividend payments to grow larger and larger. In fact, the end goal for my personal portfolio is to be able to one day live off dividends, meaning my dividend payments can completely cover my living expenses. Now, the great Warren Buffett once stated, our favorite holding period is forever. So in this video, we're going to be looking at 10 dividend stocks that you can buy and hold forever. This is about building long-term wealth, so we aren't necessarily just looking for the highest yielding stocks. Many of the largest stocks over the past decades have failed to remain at the top, so it's important we look for things like sustainable competitive advantages. Now, while there are many examples of different types of competitive advantages, such as brand power, network effects, switching cost advantages, intangible assets, and efficient scale, what a lot of people don't seem to understand is that these competitive advantages oftentimes show up in the underlying fundamentals of the company in two different ways. Let's look at an example. If we look at Microsoft stock, there's plenty of useful metrics we can see here, such as the health of their balance sheet, the fact they're growing revenues at a high rate, earnings and free cash flow at a high rate. But we want to pay close attention to return on invested capital when it comes to competitive advantages. This was one of Warren Buffett's partners, Charlie Munger's favorite metrics to look at. And essentially, it tells us how profitable are the projects the company is reinvesting their capital into. Typically, as a baseline, you want to see at least 10%, but the highest quality companies can oftentimes achieve 20% or higher. And in the case of Microsoft, they've been above 20% for 4 years in a row. And for the majority of the past decade, it's been quite good. This is a sign of a competitive advantage. The other key sign is what's happening with the gross profit ratio. If a company is able to maintain a steady gross profit ratio, or even better, continue to grow it over time, that's another example of a competitive advantage. So for Microsoft, their 10-year average gross profit ratio is 67%, but last year it came in at 69.76%. The company is growing their profitability ratio, another sign of a competitive advantage. Now, stock number one on this list is going to be a company that is deeply embedded in businesses and consumers' daily work life. And that stock is going to be Microsoft. And you can see all this data is going to automatically load in thanks to the help of the ticker data add-on in Google Sheets, link in the description. But like we know, Microsoft has been around for a long time, but despite this, over the past 5 years, they've had an earnings per share compounded annual growth rate of 18.34%. That is rapid earnings growth. Now, if we look at this stock over the last year, they're up by about 15.37%, trading at $510.05 per share, so they're essentially at an all-time high. And if we look at them in the last 5 years, up over 141%. And this is actually the largest individual position in my personal portfolio. If we blow up my growth chart, we can see Microsoft right here. It's a position I'm currently up about 94% on. Now, most people don't typically think of Microsoft when they think about dividend stocks, but when it comes to total dividends paid out from the company, they actually pay out more in dividends than any other company in the world. Now, if we look at the starting dividend yield right now, we can see it's only sitting at about 0.64%. But if we jump over to the dividend breakdown spreadsheet, you're going to see a different story. And remember, all these spreadsheets are available on tickerdata.com. But yes, we can see the starting dividend yield from Microsoft, just 0.64%. But the company has a long history of increasing the amount they pay out in dividends every single year. For example, in 2014, they're only paying out about $1.15 per share, but by 2024, it was $3.08 per share. Over the past decade, they've been increasing the amount they actually pay out in dividends by close to 10% every single year. And on top of this, even though they're growing their dividend at a very healthy rate, the free cash flow payout ratio is below 30%. And in fact, the free cash flow payout ratio has been declining over the past decade, getting even healthier. Now, for each of the stocks we look at, it's important we understand where it lies in the dividend growth pyramid. For example, this is something important to understand. If you have a long-term time horizon, then you should be focusing on stocks with high levels of dividend growth. Think of stocks like Microsoft, Costco, Visa, and Lowe's. The starting yields might be low, but they're going to increase their dividend payouts by a large amount. The reason behind this is over the long term, dividend growth stocks actually have the potential to pay out more than high-yield stocks, even if we reinvest those dividends over time. But with that being said, if you have a shorter time horizon until you want to live off dividends, you should be closer to the bottom of the dividend growth pyramid where you can get higher yielding investments even if they have lower dividend growth. Now, with that being said, this is about stocks that we can buy and hold forever. And remember our two key metrics, return on invested capital and gross profit ratio. Microsoft is phenomenal, like we've already seen at about 22.61% last year, and the gross profit ratio has been increasing at 69.76%. What a lot of people don't realize about Microsoft is they're essentially a tech ETF at this point. If we look at their recent earnings report, they list out the product and services that they offer. It looks like there's about 20. And what you'll notice is the vast majority of each of these business segments are growing revenue and earnings at a double-digit rate. At this point, they're essentially a tech ETF with multiple diversified revenue streams. If we look at their competitive advantages, they have network effects. The more people and businesses that use Microsoft software, the more valuable that it becomes to others. They have switching costs. The vast majority of enterprises are deeply integrated into Microsoft's ecosystem. I mean, imagine trying to conduct business without having access to things like Excel or Word or even your email. And then they certainly have intangible assets with a lot of proprietary software. Microsoft's been around for a long time, and that doesn't seem to be changing anytime soon. With all that being said, I will say that the valuation is a bit steep right now, at least compared to how they've historically traded. We can see that 4-year average PE ratio sitting at about 33.35, and the current PE ratio sitting at about 39.36. So if we jump over to the stock valuation spreadsheet and look at Microsoft, and then look at that historic multiple valuation, again, what we will see is compared to how they've historically traded, they're quite a bit more expensive. The average PE ratio over the last decade, about 31.1. For the trailing 12 months, 39.24. That's about 26% more expensive than they've traded historically speaking. The next company is actually another one that I own in my portfolio. I love owning companies I believe I can buy and hold forever, and with that being said, there's another company very similar to it in MasterCard. Now, what we can see about Visa and MasterCard is, again, over the last 5 years, they've done a great job at growing earnings, with Visa at about close to a 13% 5-year EPS CAGR and MasterCard close to 12%. In fact, because we're looking at both of these stocks at the same time, let's just use the stock comparison sheet. We'll come up here and plug in Visa, and then over here, we'll plug in MasterCard. There's a couple of things we need to point out. To start, the performance of both of these stocks has been absolutely phenomenal, whether you look at it on a 1-month, 1-year, 5-year, or 10-year basis. And the dividend metrics are impressive as well. Now again, both of these are stocks that are at the very top of the dividend growth pyramid. There's no doubt about this, but the dividend growth has been so good. For example, in just the last 5 years, MasterCard has doubled the amount they're paying out in dividends. Visa, they've increased the amount they're paying out in dividends in total by over 151%. If we look at it over the past decade, it's 548% for Visa, and MasterCard almost 500%. So we're talking about in just a 10-year time period, a 5x increase in the amount they're paying out in dividends, all with the payout ratio staying extremely healthy. And the reason they're able to do this so easily is because earnings are growing, free cash flow are growing at a high rate, and it's projected to continue to do so in the future. And on top of this, we can see just phenomenal profit margins. Look at the gross profit margin for Visa, 80.4%. MasterCard, 76.31%. On top of this, if we look at the return on invested capital for both of these companies, again, telling us how profitable are the projects they're reinvesting their capital back into. It's very high, 28% for Visa, MasterCard, 44% last year. When these companies reinvest back into the business, it allows them to grow free cash flow at a high rate, which is exactly the same reason they're able to grow those dividend payments at such a high rate over the past 5 and 10 years. On top of this, these two companies dominate their market. They both have massive brand power. They're a globally recognized payment brand trusted by billions of people. But most importantly for these two companies is the network effects and the switching cost. When more merchants become accepting of either Visa or MasterCard, it increases the attractiveness to consumers and vice versa. If somebody's starting a small business, it's likely they're going to be focused on taking payments from Visa and MasterCard. Because of this, both of these companies are deeply entrenched in the global payment infrastructure. Even with the threat of stablecoins, their network is so vast they could easily implement new strategies to become the leader in stablecoins. To me, these are two companies you should be able to buy and hold for the long term. Just keep in mind that when it comes to valuation, right now, Visa's trading at a much lower price to earnings multiple than MasterCard is. But with that being said, MasterCard is projected to grow earnings over the next 4 years faster than Visa is. Next on our list is a stock that I think is particularly interesting right now, especially when it comes to the valuation, and that's going to be ASML Holding, currently trading at about $734 per share. Over the past 5 years, their EPS CAGR has been above 25%, so we're talking about absolutely rapid earnings growth. But despite this, the stock is only up about 4.88% year to date. In fact, if we take a closer look, in the last year, they've actually sold off by 20.51%. At their peak, they were once trading at about $1,100 per share. And because of this sell-off, the stock is trading at a much lower valuation when it comes to the current PE ratio compared to their 4-year average PE ratio. Now, if you aren't aware of ASML, this company is a true monopoly. This is something I was writing about over on Dividendology.com just the other day. They're the only company in the world that creates EUV lithography machines. Let me explain just how important these machines are. Without ASML, there's no EUV lithography. With no EUV lithography, there's no Taiwan Semiconductor or Intel. And without them, there's no NVIDIA GPUs, no Apple or Qualcomm chips, no iPhones, no cloud servers, and no ChatGPT. I think you get the point. So ASML is creating the machines. That's basically driving the growth for the entire AI semiconductor value chain. They don't have any competitors, and it's estimated that if you even wanted to compete with ASML, you'd be at least a decade behind due to the fact they're heavily reinvesting back into the business through research and development. Now, if we look at this stock from a dividend perspective, what we can see is another low yielder, a little bit below 1%, but that 10-year dividend CAGR sitting at about 23.26%. Now, keep in mind, this is a European dividend stock, so a lot of the times the European stocks will pay out dividends on a semi-annual basis, which happens to be the case for ASML. Now, let's talk about the return on invested capital and the profit margins. What we can see is for the last 4 years, ASML has had return on invested capital of above 20%, and before that, it was still quite decent. For example, even in 2020, it was around 17%. Now, what's interesting is if we look at the gross profit ratio for ASML over the past decade charted out, we can see it here. ASML's gross profit ratio hasn't just remained stable, it's been increasing. Those margins are expanding. The 10-year average gross profit ratio is about 47.8, but last year's came in at 51.28%. So when it comes to their competitive advantage, it's clear switching cost is the main one. They're absolutely critical to the semiconductor manufacturing ecosystem. These companies simply can't switch from ASML. And like I mentioned earlier, the valuation is quite interesting at its current prices. If we jump over to the stock valuation sheet, let's look at ASML. The first valuation that I want to glance at is our discounted cash flow analysis. Analysts are projecting that ASML will be growing earnings and free cash flow at around maybe 18% over the next 4 to 5 years. So if we make a more conservative estimate and assume 16% free cash flow growth moving forward, we still come to an intrinsic value of $976 per share, which is about 33% higher than that current share price. If we look at the historical multiple valuation, we can see over the trailing 12 months that PE ratio is only about 26, when on average over the last decade, it's closer to about 35. That's 25% cheaper than it's traded historically over the past decade. And then if we look at the dividend discount model, assuming they grow their dividend at a rate of about 7.75% moving forward, they'd be worth $943 per share, 28% higher than that current share price. So in my opinion, yes, you could buy and hold ASML for a long time period, and the valuation looks quite attractive right now. The fifth stock that is on our list is going to be stock ticker AVGO, which is Broadcom. And if we look at Broadcom in the last year, they're up 76.51%. In the last 5 years, up about 793%, trading at $283.34 per share. Now, if we look at Broadcom, yes, they've been growing earnings at a high rate, but what's really interesting is how fast they're projected to grow earnings moving forward. For example, if we jump over to Seeking Alpha and look at those earnings estimates for this stock, over the next year, they're projected to grow earnings at about 37%, the next year 23%, the next year 25%. There is a massive growth runway for this company up ahead of them. And because of this, investors are willing to pay sky-high prices for the stock. For example, the 4-year average PE ratio is sitting at about 51.47. And complete transparency, like always, this is a stock in my personal portfolio, and in fact, this is the biggest winner. We can see I'm currently up about 457% on this position. Now, what's interesting is if you look at that starting dividend yield, again, like these other stocks, it's below 1%. But if we look at my dividend yield on cost for this position by jumping over to my dividend dashboard and blowing this up, we can see Broadcom right here. My yield on cost is 4.43%. Now, the reason the yield on cost in my portfolio is so much higher than the stock's current dividend yield is because, yes, I bought in at a good valuation, but they've been growing the dividend at just a mind-blowing rate. And this is something they highlight in their investors presentation. From 2026 to 2025, the dividend compounded annual growth rate is 32%. So they went from paying out about 19 cents per share to now over $2.36 per share. And with the way that earnings and free cash flow are projected to grow moving forward, that shouldn't change too much. Now, return on invested capital data is a little bit messy for the stock over the last year, but on average, it's been around 20%, and the gross profit ratio looks great at 63.03%. Like many of the other stocks on our list today, if we look at the gross profit ratio over time for Broadcom, those margins have been expanding by a wide amount. Look, the gross profit ratio in 2014, 43.97, and in 2024, just a decade later, 63%. So when you're growing revenues at a 10-year revenue CAGR of 28.3% and at the same time expanding your margins by a wide amount, it causes earnings and free cash flow to explode. It's no wonder the stock is up so much. Now, when it comes to Broadcom, like all the rest of the other stocks on this list, they have a competitive advantage when it comes to switching cost. Broadcom semiconductors are deeply integrated into hardware designs, making it pretty costly to change if you're a supplier. On top of this, they have cost advantages. Broadcom's specialization and also their scale allow it to produce components very efficiently. And along with this, they have intangible assets because they have patents. Broadcom continues to have a clear runway towards growth. So halfway through the list, you're probably noticing a trend. We're pretty tech heavy, but the back half of this list is going to show a few different stocks in different industries. So stock number 6 is going to be Costco, stock ticker COST. And if we look at Costco over the last year, they're up by about 13.29%, trading at $950.95 per share. And look at this performance over the last 5 years, up nearly 200%. Now, this is an expensive stock, but it's pretty much always been an expensive stock. The 4-year average PE ratio sitting at 43.21. Right now, it's 53.82. It's rare to find a non-tech stock trading at that high of a valuation multiple. But to be fair, they have been growing earnings at a healthy rate, close to about 15% when it comes to the 5-year EPS CAGR. Now, what makes Costco so special? Why is it on a list that you could buy and hold forever? And here's the magic number, right here. It's the renewal rate for their members. To shop at Costco, you have to have a subscription. You have to have a membership. For lots of software companies, you're excited if your renewal rate can be around 60, 70, or even 80%. The renewal rate for Costco memberships in the US and Canada is nearly 93%. Nearly everyone who becomes a member stays a member. And keep in mind, new members are joining every single year. What this does is it creates a very predictable revenue stream, a very predictable earning stream. In fact, if we go ahead and jump over to the stock screener, let's just look at Costco. And the charts we'll see are truly a thing of beauty. It's very rare to see a stock where every single year revenue continues to grow. Every single year, there's not a lot of fluctuations. Look at this earnings per share growth chart. Every single year, including even 2020. A lot of companies really struggled that year, but like clockwork, Costco continued to grow earnings per share every single year. It's going higher. And this brings about an interesting point. One of the reasons that Costco trades at such a premium is due to the fact investors absolutely love predictability. If you can feel confident that your holding is going to continue to grow earnings at a healthy rate every single year, you're going to be willing to pay a premium for that. But again, with that being said, Costco is certainly at a high premium. Right now, the dividend yield is sitting at about 0.5% and the 5-year dividend CAGR around 12.3%. Now, the gross profit ratio for this business is much lower than the other stocks on this list that are tech heavy, but this really isn't much of a red flag. This is pretty standard for the industry that Costco operates in. So the major competitive advantage for Costco truly is brand power. The members that join rarely leave. I don't know if you know any Costco members in your life, but they love talking about how much they love Costco. On top of this, of course, their switching costs. Costco is much more price efficient due to their bulk purchasing power. And then, of course, their switching costs. The membership model incentivizes repeat purchases and customer stickiness. And then with the bulk purchasing, it gives Costco cost advantages. There's not many stocks in this sector you could consider buy and hold forever, but Costco is probably one of them. With that being said, it's difficult to get in at the right valuation. Now, the 7th stock on the list is one I'm really excited to mention, not just because it has one of the strongest moats on the list, but also because the valuation looks quite interesting at its current price, and that's Canadian National Railway Company. Now, there's a couple of things that probably jump out right from the start. The 5-year earnings CAGR is significantly lower than the other stocks that we've seen on this list so far. On top of this, the current PE ratio is actually lower than its average 4-year PE ratio. ASML is the only other stock on this list where that's the case. The year-to-date change is down by about 2%, and the 3-year return down by about 11.5%. So why is this company on the list? Well, let's dive into things just a little bit more. To start, let's take a look at that dividend history. To start, we can see this is a company with a 2.5% starting dividend yield, so still not high, but significantly higher than the other companies on the list so far, and on top of this, a great history of growing those dividends, with a 10-year dividend CAGR of around 10%. So with all this being said, I think a lot of people don't realize just how strong the moat is for Canadian National Railway. They have a rail infrastructure that is completely irreplaceable for many logistic routes. And this is a very capital-intensive business, at least starting out. There's virtually no threats of new entrants in this sector. Because just think how much time and how capital intensive it would be to build a rail system that spans from New Orleans all the way to Vancouver, all the way to Quebec. CNI has very little competition, and they have lots of demand for their services. And on top of this, despite poor returns over the last few years, based on the current valuation, the stock is looking attractive. For example, if we jump over to the sensitivity analysis, I've already plugged in CNI. One of the cool features of ticker data is if we come over here, we can see the average estimated earnings per share projection by analysts through the year 2029. This is the average EPS estimate from analysts. So the projected EPS CAGR through the year 2029 for this stock on average is 11%. So let's come to our 2029-2030 price target based off of that. We'll go with the average and assume 11% EPS growth. On top of this, let's enter our projected PE ratio for the future. The average PE ratio over the last decade is about 20. The trailing 12 months PE ratio is about 19. So let's go in the middle and say it recovers to 19.5. Here's the results that we can see, which are so impressive. By the year 2029, the share price would be $241, giving us a total return of 142% and a compounded annual return of 19.37%. So if they can achieve just the average analyst expectation of 11% earnings growth and hold on to that price to earnings multiple they've historically traded at, the returns look quite attractive. So no doubt, an attractive valuation in a company with clear competitive advantages. The next stock on our list is going to be another industrial stock, and that's going to be Waste Management, stock ticker WM. Now, when we look at this stock, we can see they're trading at $227 per share, and over the last 5 years have an EPS CAGR of nearly 12%. That's quite a bit faster earnings growth than I think a lot of people are expecting over the last 5 years. If we look at how the stock has been trading, we can see it's close to its all-time high. In the last year, up about 1.89%, but if we look at the last 5 years, up over 113%. So the performance has been quite impressive. Now, from a dividend perspective, we can see they're only yielding about 1.4%, but a very steady history of growing that dividend over time, with the 10 and 5-year dividend CAGRs both about 7.5%. Now, the reason this stock is on this list is quite clear, actually. The trash business is not going away. In fact, in their investors presentation, they highlight something extremely important. They stated that 75% of their revenue has annuity-like characteristics. What does this mean? Well, it means the vast majority of their revenue is recurring, it's predictable, and it's stable over time. These customers are paying on a very regular basis, either monthly, quarterly, or annually. And for that reason, just like Costco, this is another business that people seem to be willing to pay a premium for. The gross profit ratio for their sector is still quite good, obviously not comparable to the tech stocks, but good for their sector. Now, return on invested capital, a little bit lower than I typically like to see it last year, but on average is still quite healthy. With that being said, if we look at the valuation for this stock, and look at the historical multiple valuation, again, we see a stock trading at quite a bit of a premium compared to the historical valuation. The average PE ratio over the last 10 years is already fairly high at about 29. Right now, for the trailing 12 months, it's sitting at 34. That's about an 18% increase from the average over the past decade. So yes, certainly a great business model with very stable, predictable revenue streams. Company is trading at a premium. This is a stock that I own in my personal portfolio, and we can see I'm currently up close to about 50%. The next stock on our list is one that doesn't get a lot of coverage from traditional media in the finance space, and that is MPLX. Now, if you haven't heard of this company before, they're actually what's known as an MLP, or a Master Limited Partnership. We can see MPLX is currently trading at $50.80, and over the last 5 years, they've grown earnings faster than any other company on this list at a compounded annual growth rate of 32.52%. And because of that, if we look at their performance in the last 5 years, They've way outperformed the market, up nearly 177%, and that doesn't actually include dividends. If we do include dividends, that total return actually comes out to 353%. That's a huge jump up. Why is that the case? And that's because they're a huge dividend payer. Look at the starting dividend yield for this stock. Right now, it's sitting at about 7.54%. So out of all the stocks on the list, this is obviously the only high yielder we have right now. That's a high starting dividend yield. But on top of this, they've continued to grow the dividend at a very healthy rate with a 5-year dividend CAGR of close to around 6%. That's a very nice combination of starting dividend yield with dividend growth. Now, one of the things you'll notice about this stock is out of all the companies on the list, it has the highest gross profit ratio. Why is this? Why is that the case? What's their business model? Well, MPLX owns pipelines, storage terminals, and processing facilities. So essentially, they're in the energy sector. Now, most companies in the energy sector don't necessarily have high profit margins, but MPLX is unique. MPLX owns the pipelines that transport crude oil, natural gas, and refined products, and customers like oil producers and refiners pay fees to use these pipelines, and they're typically under very long-term contracts. What's great about that is it provides a steady income stream regardless of commodity prices. So again, like Waste Management, there's some annuity-like characteristics with their revenue streams. What's also great is while there's a lot of assets here like pipelines, storage terminals, and processing facilities, these can be capital intensive, meaning there's higher barriers to entry. These assets are difficult to replicate, but when they're done being built, the operating costs are very low. So it's easy to see why this business model is so exciting and I think in a lot of ways better than traditional energy companies. There's not as much fluctuation in the revenue and earnings growth. The profit ratios are high, return on invested capital is high, and they're able to grow that dividend at a healthy rate even with a very high starting dividend yield. The company is trading at a PE ratio that is higher than the 4-year average, but based on the reports that I'm seeing, the fact that analysts are saying the company could be growing that dividend at a 7 to 10% rate moving forward, the stock could be fairly valued or potentially even undervalued at its current prices. This one is certainly on my watch list. And then finally, we come to our stock number 10, which is going to be JP Morgan. This is going to be a bank stock, which is very unique in a lot of ways. We don't look at a lot of traditional metrics. But to start, we can see JP Morgan current price about $291 per share, the 5-year EPS CAGR at about 13%, so earnings have grown at a high rate. Now, what's interesting is JP Morgan in the last 3 years is up over 160%, not including dividends. So they've outperformed a lot of the high-flying tech stocks during this time, but they still kind of go under the radar. They don't get a lot of attention. Now, this is a stock that I actually added to my portfolio in 2022, so I've been able to enjoy a lot of the upside with JP Morgan, and I'm up about 177% on this position. It's gone really well for me. So why is JP Morgan on this list? Well, here's what we have to understand about banks. At their core, they have a very simple business model. They take in deposits and they give out loans. They pay lower interest rates on the deposits and they collect higher interest rates on the loans. This allows them to collect interest income. And basically, perhaps an oversimplification, but over the long term, this allows them to grow what is known as tangible book value per share. It's what we're looking at right here. Tangible book value per share measures the true net worth of a bank. This tells us what the actual value of the bank is if all the assets were sold and all the liabilities were paid off. And what we can see for JP Morgan since 2005, so including that 2008 crash, they've had a 10% compound annual growth rate when it comes to tangible book values. That's 2 times faster than their peers. This is one of the largest banks in the United States and really in the world. And owning this bank is really kind of like owning a piece of the growth of the American economy. Right now, their starting dividend yield is sitting at about 1.82%, and on top of this, they grow that dividend at a very nice rate. What we can see for JP Morgan is that 10-year dividend CAGR sitting at about 12% with the 5-year sitting at about 8%. Now, because we're talking about a bank stock, we really don't pay much attention to the free cash flow payout ratio. In this instance, it's the earnings payout ratio we want to pay attention to, which is only sitting at about 25%. So that's healthy. Dividend yield is decent, but the dividend growth is quite nice. and the actual business is growing at a very healthy rate. Now, on top of this, we have to remember with bank stocks, we don't really pay attention to metrics like return on invested capital. It simply doesn't hold a lot of value. Now, with that being said, again, JP Morgan is another stock that looks quite a bit more expensive compared to how it's historically traded. So it's clear JP Morgan has massive brand power. It's one of the largest banks in the world with a long-standing reputation. There's obviously switching cost. Most banks do have switching costs because switching simply causes a headache. And then, of course, the cost advantages simply due to the size of their bank. So there you go. Those are 10 dividend stocks that you can buy and hold forever. It's clear that the vast majority of these stocks are near the top of the dividend growth pyramid. The low starting dividend yield, yes, but massive dividend growth potential in the future. If you'd like to get access to any of the spreadsheets used in this video and also the ticker data add-on in Google Sheets that allows you to automatically import stock financials straight into your spreadsheet, then you can head over to tickerdata.com at the link in the description. I also put together a free spreadsheet with details on every stock that pays a dividend in the S&P 500, which you can download for free at the link in the description. So go ahead and let me know what you think of these companies in the comments down below, and like always, please don't forget to like and subscribe to the channel.